Welcome one and all. Following are the notes made from today's reading. Book, let's talk about mutual funds. Hybrid fund categories. There are a total of 6 hybrid fund. 1. Conservative hybrid fund. These funds invest in 10 and 25% in equity assets and 75 and 90% in debt instruments. They are predominantly termed a debt fund. 2. Balanced hybrid. They invest between 40 and 60% in debt and equity, each with no arbitrage. The balance between debt and equity funds. 3. Dynamic asset allocation or balanced advantage fund. They invest dynamically between equity and debt instruments. It is a go-anywhere fund between debt and equity. 4. Multi-asset allocation. They invest in a minimum of 10% in at least 3 asset classes each. These asset classes can be equity, gold, and or other cash commodities. 5. Arbitrage funds. They invest in a minimum of 65% in equity and related instruments with arbitrage strategy. That is, they make money out of spot and difference in future prices but are taxed like equity and give debt-like returns. They have no long-term growth. 6. Equity savings. They invest 65% in equity-related and 10% in debt-related instruments. The author states the following advices. Balanced hybrid or aggressive hybrid is a good option for a risk-averse first-time equity investors who want safety belt of debt in their portfolio. The author recommends that we keep the usage of debt fund categories to small and safe and try not to harvest high returns out of them. Well, not having the expectation of high returns out of them. Next, solution-oriented funds. There are 2 types of solution-oriented funds. 1. Retirement. 2. Children's fund. Retirement and children's both have a lock-in period of 5 years and or reaching the retirement age or the kid reaching age of 18 years, whichever is earlier. Both these solution-oriented funds give high expense ratio with returns similar to equity broad indexes. The others are other schemes, which include index and ETF, and funds of fund FOF, which deals in overseas and domestic. Index are called passive funds because they just mimic the index and aims to give the investor similar returns at a much lower rate of expense. Whereas an active fund hopes to beat the benchmark and gives better returns to the investor for a higher expense ratio. The author gives the same analogy of an active fund as a fine dining restaurant and a passive fund as a franchisee. The 2 broad market indexes of India are S&P Bombay Stock Exchange Sensex and Nifty 50. Both these indexes on an year-on-year basis has give 14% return for the past 30 years. Passive funds are good option for investors, especially new to the mutual fund in general and also to the equity hemisphere. We want index investing to reduce the risk of our equity portfolio. That is the main objective of having an index fund. For an average retail passive investor, it is good idea to stay with the index funds rather than ETFs. Avoid ETFs as they can be confusing. The criteria for finding a good index fund is that it should have low expense ratio with a low error tracking record. Thank you.